the 50 signifies a quarter, the 20 signifies a month, and the 10 signifies half of that, 2 weeks. And then you can go down into smaller frames, but generally speaking, on a daily chart, I'm looking at 2 weeks. I'm always looking at between. When I'm trading medium term, I'm looking to get into a position, hold it for a couple of weeks, 1, 2, or 3 weeks, wait for the market to make its move and get out. There's generally enough time with volatility for the market to make a move. So, what can we tell about this indicator and what's happening in the market and the price behavior? What are some observations that anyone can give me?
Can I ask just a question?
Sure.
This I was trying to use. If you want to change those moving averages, you click on simple moving average there. Is that right? Sorry, over here. If you want to change those, you've got 250.
Okay, yeah, sure. We can go.
Let's
Let's go both of them. I'll show you this one. So on this one here, one of the ways you could do it.
Change back. Right, change time frames. Can you get them straight?
Yes. So basically, they're fixed. So this one's 60, 50, 65.
If you change the time frame, it will stick to those values.
That's not what I found. So maybe I'll try something wrong. Do a save in between.
Yeah,
probably.
You have to confirm, and then they will not change
Okay.
each time.
I think that another thing that you can do that's really useful is that if I confirm these, and then one of the things that I can do, we'll cover it in a second. We'll go through the profiles.
I mean, one mistake people usually do when they put moving averages, when you change the time frame, they do not extend the number of data. So this is let's do the 15 minutes. See, you can't really see the moving averages here because selected period is 1 day. If you move it to 20 days, then the averages appear because the calculation is made of higher number.
And the third part is that if you wanted to save this as a profile, so basically if you want the same, so if we add one more thing to the chart, for example, if as well as moving averages, we want to look at the RSI, so we can add the RSI to this particular chart here. It's called in oscillators or oscillators RSI. So yeah, so well, that's added. Now we want to save this as our core chart. So every time we're using this, we come with the same thing. So it's too fast here. So where's the profile? Go through. So what we need to do is basically there's a save and load, which is this button here, the small button on the top. It's like the save button. Microsoft's hard to save button. So hit the save button here, and once you hit the save button, it will come up with all your profiles, and then you can name your profile. So if we make it so template 9, let's click on template 9. We can change it, and we can call it Fineco London, for example.
Why did you have two template lines?
I think there's somebody else who saved 2 template lines before, just as a name. Somebody else has done that. So
yeah, I save this when we have events. So one is for when we have a hash, some is for a hash.
Right.
So once we save this, now if you minimize this chart and then let's say for example we put up so now Apple, if you go to the indicators, save load on the indicators, we can pull up that profile. Yeah, that's perfect. So from there, you drop down and you click Fineco London, and there we go. And we have the same chart.
15 minutes, 20 days, moving averages.
So that allows you to have the same profile every time you look at the markets.
Can I indulge myself just one more?
Sure.
I found that the price on one of the charts was below this was here, down here. I couldn't get it back. I don't know where I found it.
Yeah. So basically, these bars here, you can put your mouse here and you can drag and resize the bars. So once you get in between, where it says
that didn't help me. But this was below, hidden.
So let's see this triangle here.
Yeah.
That allows you to pull the price up and down.
That's
what.
right.
Yeah. Okay. Thanks. Okay. Now I understand. Yeah. And also these can be resized. So basically, if you click on the line here, if you put your mouse over this line here, and then you can resize the chart basically. same
not
thing.
easy actually.
Yeah, no, so basically just put the mouse over, when it comes to this one, you can just basically, essentially just wait, and then yeah, you can just resize them. So the trick is just to leave, if you put your mouse on top of it, wait a second, it will turn to 2 arrows, then you can resize it. This allows you to resize the chart. It's a small triangle here. Okay. So that's fine. So let's go back to our 2 charts. We're talking about volatility, building a defensive portfolio, understanding the difference between something that's got a high beta and a low beta. And the question is, when we construct our portfolio, do we want lots of high betas in there? Do we want lots of low betas? Do we want no beta? Do we want to just scrap the beta and go for omegas? What is the strategy? And why are we looking at it? Let's go through the why first. Yes, Sean. Yeah, come on.
No, I mean, omegas. But no, if you want a defensive...
Omega's a nice watch.
Yeah. Defensive strategy, low beta.
Yep. One defensive strategy is to have low betas.
Aggressive to have high betas.
So every type of strategy has an advantage and a disadvantage. When we select just low betas, what is the advantage and what is the disadvantage? Should I cover those?
It's not going to move. Well, profits and losses aren't going to be that much.
Sometimes, except that. All right. So let's recap the question. The question was, if we choose a portfolio with just low betas, it's a strategy, and people use that strategy, and it's a valid strategy in the market. And my further question was, let's discuss what are the advantages and the disadvantages. And one of the clear advantages was that you said that it's not going to make a lot of profit or a lot of loss.
Yes.
Capital preservation.
Okay. Okay, so I'll expand on that. So I think what he's trying to say is that
In relation
when
to
the market moves, if the market crashes, that's not going to crash. If the market rallies up really strongly, that's not going to go up very strongly. But stocks with a very low beta can by themselves have a lot of volatility, just a low beta, because they're not correlated to the market. So, for example, when I was following my trend, the strategy I told you earlier, the EAT strategy, when I learned that strategy in 1995, when I read this book and I read this comment, I thought it's profound. It's the most stupid comment in the world. You know, poker, if you stab yourself with the E, here you see. And the here and you see, I'm not sure if that's quite right when I made that up, but it made sense to me. So I said, look, you know, at that point there was this company called PIZ. Anyone remember PIZ? Pizza Express. And there was this article about this new chain this is back in the 90s. This new chain's arrived in the UK. This wonderful pizza. I checked it out and thought, you know what? Pizza's all right. Tastes okay. Stock probably do pretty well. I found pizza's only £4, £5 for a pizza, pretty cheap. So the whole family would probably go there and eat. And then my parents have been dragging me to Pizza Hut since I was a little kid, because Pizza Hut was the phenomenon in the UK. And this was the disruptor, because they had skinny pizzas. Not fat ones, because Pizza Hut always had the deep pan, right? That was their thing. Pizza Express came across the skinny pizza. I'm sure, you know, I said, well, this is going to be quite interesting. So I started buying, I think it's gone now, the stock. Many times. Yeah, it's 1990s had the story.
Domino's Pizza came
Now,
out.
Domino's, great
Quite
example.
a great,
Really, yeah, let's look at Domino's. Great example.
It's another one.
It's great example. Superb example. Papa John's. Yeah, these are really great examples. The Mexican chain that's in the States, Chipotle.
Yeah.
Wonderful. Also, if you follow them. So the simplest trends can be good. So defensive, low beta, you can do that, but don't do a low beta stock in a rising market, because you don't benefit from the rising stocks. So what you can do in that situation is you have some stocks with some low betas, and you have some stocks with some high betas. So then the name of that strategy is called a barbell strategy. So because you have something on one end, something on the other end, and you hold it in between. So very low betas, so less than 0.75, 0.5, and high betas 1.25, 1.5. It's called a barbell strategy. And what that allows you to do is that when the market's going down, your defensive stocks aren't that effective. They may still keep going up. If the market's going up a lot, maybe they're not doing a lot, but your FTSE 100, your S&P 500 stocks, they're going to do well. And then that will be called a balanced portfolio. So that's one way to use betas to check if your portfolio is balanced. So if you have 5 stocks in your portfolio and you go and look at them and they're all 1.5, you have to say that if that market makes a correction, you're going to be in for a rough ride. So you want to make sure that you can check that. So you have a couple of stocks that have low betas in your portfolio. So that's one way to look at it. The second question that I covered is the 4 moving averages. What other analysis do we want to put on the chart to see what we like and what we don't like?
Support and resistance.
Support and resistance. Okay, so this is Domino's 10 years. Does it? Yeah. So let's go. Can we go back? Oh, can we put a monthly chart up for this? Okay. Thank God for pizza. If you just bought Domino's pizza, we could all retired 10 years ago, right? Because it's done so well. Good old Domino's. Where is it stopped? 300. So what's our big number? So obvious, isn't it? They must have heard me when I said Apple at 300. They got it wrong. It's on Domino's. But yeah, but it's like, it's really classic. Who's selling at 300? All those people that bought at what price? No. Think the exact number I gave you the example.
Maybe
In Apple.
250 or
No, 150. 150. Why? Remember that. Psychologically, always remember this. Psychologically, whenever a stock doubles from a big whole number price, where there is a support level. So let's put 150 on this chart, and let's find out if the market, if that was a support level on this chart, 150.
yeah, I can see it.
Come down to 150, maybe it is, it does exist, maybe it doesn't.
It does.
Sure.
It tests it twice. In 150 level, yeah.
Okay.
Kind of.
So, yeah,
Kind of
hard
bounce.
to call the 150 on this one. What about on 100?
Just below 100. I think it just below 100. It.
Okay,
Oh,
so,
just
so
yeah.
100 to 200 was a stronger relationship. But this has just been really strong. So yeah, so the challenge is that I can't really tell you where this rally started. It didn't really start at 100. It didn't start at 150. It didn't start at 200. I mean, it started way back over here. It hasn't really had a big correction. And the biggest correction it has had has been somewhere around 165, 170, this correction here. And even that wasn't a really bad correction because it just kind of it dipped below. It's really not strong at all, that correction. So it's just been a really strong stock. Like this last, is it a correction we're seeing here? That's the first question.
No, it's gonna get higher. Looks like.
How do we define a correction? 10% is one way of defining correction. That's a good idea. So from 300 to 270.
There'll be more
Good
sales than
point.
buys, for example, and there's more green bars. There's more buys still at the moment.
Okay, so another way to define it is that there's a string of sellers, constant sellers that push the market down. We have seen a little bit of that. So it's gone from 300 in this last pullback. What's the low price in
Why are 2018 there? I thought we were in 2019.
yeah,
And it's because it's a monthly chart. So this is
It's only 3 months in the last data period. 4 months now. So in this last correction, yeah, it's basically gone down to about 245.
This one is the minimum here is 166.75.
And what about in December?
Then this one.
That one, yeah. So the low was 231. Okay, yes, that's the 300 to 231. That's way over 10%, so over 20%. That's a decent correction. Okay, so let's put it. So we know that the market's had a good run, and it's had a correction. We agree on that. So we go to a weekly chart now, and on the weekly chart, that's great. You can have less data, 5 years more than 4 years. That's perfect. On the weekly chart, okay, there's nice setup here. Well, what's the next thing we're observing?
Double top.
It's a double top at 300. It's not quite a double top. It's almost a double top, right? Which means that on this rally here, the market didn't have enough energy to make it a double top. What's the difference between this setup and a double top? The difference is, my experience, because there's no right or wrong to this answer. My experience just tells me when I see a double top, I'm more likely to see a follow-through correction and break the last swing low here. Why? Because the market's tested the old high, didn't like it, and there's been some follow-through on the selling. In this scenario here, there's more likely to be a correction and a rally. More likely. Not always, but more likely. So, we've seen on the first correction, we set this low here. On the second correction, we've set this low here. So, when we have two corrections at the top, two corrections at the bottom, what technical analysis pattern formation are we beginning to build? What's it going to look like if we go ahead 3 months from now? What should it look like? A triangle should make a triangle pattern. So I'll draw a line across the top from here, going down. I'll draw a line from this low coming up from here to here, and see how the pattern's forming up. How it's forming up. So it's quite a wide triangle. So that's yeah. That will have to move that bar up a little bit. The top one on the right hand side. There we go. Okay. And this one here, I pull this one back all the way to here, this bottom bar, and put it to this low here. Okay, and you can shift that one up a little bit. Okay, so it's not a clean triangle at all right now as a formation, but it's trading in somewhat of a triangle formation. Where is the breakout on that? There's two breakout parts. What are those two breakout parts? One is above the line, and one is above the swing high. Okay? Which of the two is more reliable, the triangle or the swing high? First question.
Sorry, I didn't get the question.
There's two places this chart can break out. One is on this line. There's only 2 points on this line, so it's not really a resistance line. 2 points don't make a good quality resistance line. Not at all. We need 3 at least. That's the first thing to observe. Even on this one here, we've got 1, 2, 3, and we missed this one here. It's messy. So on the breakout of this line, it's not so guaranteed that we're having a breakout. Not guaranteed at all. It's not strong. If it breaks this swing high here, yeah, now we're saying something. But this swing high is very close to this swing high. So if it breaks both of those and tests above there, and yet get a green bar that forms above there, we've started our new trend. And that is very important for us to start our new trend at that stage. So, next thing to analyze, we're going to look at the moving averages. Where is it in relation to the moving average? The work we did last week. Are the moving averages ascending or descending? Descending. Is the market bouncing on any of these moving averages? Not really. It's not really contained or held by any of them. Not on the weekly chart, anyhow. If we go back to the monthly chart for a second. That's all right. That's when you go to the monthly. You hardly see it. Okay, on the monthly chart, are we bouncing on any one line? There's a bit of a clue there. 1, 2. It tried, failed, 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 failed. So this green line. How do we know what the green line is? It's the 20-year moving average, right? It's the monthly moving average, and we're in the monthly chart. So it's good. So that tells me that if this market closes below this green moving average, what strategy should I be looking at? A shorting strategy. As long as it holds above the green line, I should be looking at long strategies. Okay, so then the next thing we look at here is that, let's look at the daily chart now. Okay, so, yeah, it's perfect. So, the market's broken out of it's come down. Oh, this is a very old technical analysis strategy. Can anyone see it? A cup and a handle. It's a saucer when it begins, and it becomes a cup and a handle. It's a very old strategy. You don't see it so much anymore. And what it's trying to say is that the market tried to bottom out, tried to sell off again, only came halfway between the bottom and the top of the range. It's slightly more than halfway in this thing. And it went back to the top and then broke out. So it's a cup and handle strategy. Again, so let's look at the moving averages on this.
Refresh the color.
No, if you just click on the moving averages. Oh yeah, perfect. So the 200 is in blue. Maybe it changes to purple or something because it's confusing with or any other color. Okay. All right. So it stopped at the 200 period moving average today. We've got this space in the chart, a little space here. Now, what do we call this space? A gap. Why is a gap significant?
Some say that will be filled.
Some say they will be filled. What happens at the time of the gap? What happened at the time of that gap? How do we know? How do we tell what happened at the time of this gap?
It's some news.
We can say we see that it's a red bar here and a red bar here. We see the market opened here, closed on that day there, opened on this day here, closed on this. So basically, in between this day and this day, the market gapped closed in February. So we've got to ask ourselves why. How can we find out what happened? We're trading this stock, Domino's. How do we find out what's been going on? So where do we go look for the news? We can go back to maybe to the internet platform, go back to the web platform. We pull up Domino's and we see if there's anything that you can tell us about the stock.
In fact, in Netherlands, these functions
Events,
shows,
yeah.
when they did
Okay, Domino's Pizza falls after first profit miss in at least 9 quarters. The chain shares down by 7.2% at 258.
this is the date I checked
Pre-market trading.
our business, so this is the 21st of February.
Yeah, perfect. Yeah, so basically they missed on their earnings after a long period of time. So, is that a good sign or a bad sign? How bad is it though? Not very bad. No, I wouldn't say it's very bad because you have to read into the data. As a general rule, ignoring Domino's, when a company misses for the first time, it's negative, but it's not that bad. When a company misses for a second time, okay, now they need to make some changes. When a company misses a third time, it's because they tried to make the changes and the markets, there's a big problem. That's the general rule. So when the company misses on the first time, it was a bad market, Christmas wasn't good, we don't know why. It gives all the investors an opportunity to buy the stock a little bit cheaper than they would ordinarily do. And institutional investors know that. You can't judge a stock on one quarter. You have to judge a stock over its management. So, and so far, up until now, it's been when Apple had a bad quarter 3 years ago, and the stock sold off. Those who bought it were probably retired because it did really well. It almost doubled in the period after it had its bad quarter, and it had a bad quarter. Why? Do you remember the iPhone problem they had? I mean, they've had a couple. They had the bending iPhone, and they had the burning iPhone, the one with and then they had the battery limited iPhone. That was right, yeah. So it's like 5 generations ago. But up until then, they had a really good track record, and they came out with one bad product. They throw the whole company away? No. It's an opportunity to do what? To buy the stock at a cheaper price. As long as you monitor it and have... Right, let's go through Domino's.
Is it a Boeing now time to buy?
Boeing.
Boeing.
Good, yeah,
Not
good point.
yet.
Yeah, we have to watch, wait and see. And yeah, you're right. Is Boeing a bad company? Track record's been good. Did they make one mistake on this plane? Yeah, they did. Let's admit it. They made a bad mistake. I mean, a lot of people died. Terrible, horrific mistake. Can they recover? There's a good probability. Shell, when they had their disaster. Bad mistake? Yeah. Well, BP. Yeah. Only reason I'm thinking of Shell is because I've read in the paper the woman that stuck her hand to the door today.